Hello everyone, welcome to lecture number 2, which is going to delve into the liquidity ratios. In essence, when we are talking about the business and their activities related to different functional domain, it is imperative on the part of the business to ensure that sufficient circulating capital is available to meet the expenses and the financial needs as and when they emerge. And it is very essential whenever we are going to talk about the analysis of financial states of affairs backed by financial decision making, both at the end of the internal users as well as at the end of the external users who are equally interested to know whether the company or the corporate entity is in a position to meet its short term financial requirements and whether the company is having sufficient liquid fund to ensure that all these operating or recurring activities are not going to be paused because of paucity or deficiency of capital in the form of circulation. When we are going to talk about liquidity ratios, it addresses a bunches, but before delving into those categories, let us formally discuss what liquidity ratio simply implies. Liquidity refers to the ability of a company to meet its near future obligations. In other words, whether the company is having sufficient liquid fund to meet its short term obligations, which is otherwise having a very strong bearing on the efficiency as well as the operating consecutiveness and the perpetual execution of different activities as and when they are required in different functional domains. Now, when you are going to talk about liquidity ratios, as we are more or less inclined towards digging out whether the company is having sufficient circulating capital or liquid cash available at their disposal to meet the obligations emanating from different activities in the form of different expenses, it is there to take a note of the bunches of current assets and current liabilities which are backed by the very characteristic of being easily converted into cash without any shrinkage of its value. So, indirectly liquidity ratios are going to make use of financial information pertaining to current assets and current liabilities which are disclosed in the financial statement, specifically in the balance sheet. Moving further, when we are going to talk about the genres of liquidity ratios, to start with, the first ratio which is extensively used to address whether the business is in a position to meet its near future requirements or not, we are using current ratio. Current ratio measures a company's ability to pay its short-term liabilities with its short-term assets. Now, when you are going to talk about the use and application of current assets to meet its short-term obligation or to pay off the current liabilities, the inherent orientation is that whether the current assets are easily converted into cash without any shrinkage in its value, and the accumulation of those converted values of current assets would be utilized to pay off the immediate as well as the short term liabilities to which a company is exposed as a consequence to the execution of different operating activities. Now, the normal orientation to calculate current ratio is to establish a causal relationship between the current assets and current liabilities in its totality. So, for the calculation of current ratio, we are there to make the sum total of all the current assets in one hand, and we are there to make the sum total of all the current liabilities on the other hand, and we are there to express current liabilities in terms of current assets and vice versa. It can be reciprocal, it can be direct. So, it does not make any difference the way you are there to interpret the classical formula to calculate current ratio is total of current asset upon total of current liabilities. Now, there prevails a rule of thumb which is used as a standard whenever we are going to talk about current ratios. It is generally apprehended that if the current asset is 2 times the total of current liabilities, it is interpreted that the firm has sufficient liquid cash after conversion of current assets to meet the current liabilities or to pay off the near future financial obligations, but it is not a necessary condition. There are prevalences where the current asset is more than 2 times the current liabilities, but the firm or the companies are facing liquidity crunch. So, there are different logical reasons behind such consequences. Even though the current assets are more than 2 times the current liabilities, what makes the companies to end up in a state of liquidity crunch? One of the logical answer is that the current assets comprises of, in general, cash in hand, cash at bank, marketable securities, debtors, inventories, bills receivable, prepaid expenses, and so on and so forth. But all these current assets are not so easily and equally convertible into cash. So hence, if there is heavy prevalence of inventory in the total of current assets, then obviously the companies are going to take much time to convert inventories into cash, because that can only be converted into cash through magnifying the quantum of sales and generation of revenues, which is not at all easy state of affair in this competitive world of business. So, if there is the prevalence of heavy quantum of inventory which is lying within the total of current assets, then it may lead to a situation of liquidity crunch, though in the books it is showing that the total current asset is sufficient enough to meet the current liabilities, but in practicality the companies are facing liquidity crunch or shortage of hard cash to pay off or to meet their short-term obligations on a recurring basis. Now, moving further, next in the line is the liquid ratio. It is also more popularly known as quick ratio. It is a more conservative way to address whether the company is there to meet the short-term obligations or near future financial requirements or not. Now, whenever we are going to go for the calculation of liquid ratio or quick ratio, we are there to understand what is liquid assets. Liquid asset, simply the sum total of current assets except inventory and prepaid expenses, because it is logically argued that inventories are not so easily converted into cash. So, when we are going to have a restrictive approach to address the short-term obligations and the ability of a company to meet such short-term obligations, it is always imperative to exclude inventory from the total of current assets and express the same in terms of current liabilities. So, by doing such conservative approach and by making calculation of liquid ratio, we are in a better position, as well as we are close to comment about the ability of a company to meet its near future financial obligations. As a rule of thumb, if the total of current asset is going to be equal to or more than the total of current liabilities, it is interpreted that the company is having sufficient liquidity to meet its short-term financial obligations. But again, there are adversaries to such situations. There are many practical instances where it was witnessed and experienced that companies who are having more than the current liabilities in terms of current assets, but still they are having shortage of liquid cash to meet their day-to-day recurring expenses. So, there are different reasons for such orientations, because when you are going to talk about liquid asset, the prevalence of heavy quantum of debtors or bills receivable, which is adding up to the sum total of current assets, is going to behave otherwise when we are going to talk about the ability of a company to meet its short-term obligations, because as per the whims and fancies of the companies, the cash is not expected to be realized from the credit customers. There are always deficiencies in terms of realization due to XYZ reasons. Now, if there is the heavy prevalence of debtors, bills receivables in the sum total of current asset, obviously as per rule of thumb we are saying that we are better off, but in actual we are not that well off to meet our short term obligations. Now, moving further, when you are going to talk about the formula, as I had already mentioned, the formula to calculate quick ratio is the liquid asset upon the current liabilities, where liquid asset represents the sum total of current asset minus inventory minus prepaid expenses, and current in the denominator the current liabilities would remain the same. In a stringent orientation, in certain cases we may exclude bank overdraft from the current liabilities when we are going to talk about liquid ratios. In the same line, the next ratio which is equally addressing the liquidity status of a company is the absolute liquid ratio. Perhaps it is the most stringent measure to address the ability of a company to meet its short term obligations, and absolute liquid ratio is going to only accommodate those current assets which are almost on the verge of being converted into cash without any loss in value or without any shrinkage in value, and they are essentially the cash in hand, the cash at bank, the marketable securities and short term investments which are at the disposal of the company. We are there to make the sum total of all these four components in order to calculate absolute liquid assets. Now, to calculate the absolute liquid ratio, we are there to establish a relationship between absolute liquid assets and the current liabilities. Again, in current liabilities, on a stringent orientation, we may exclude bank overdraft for calculating the total of current liabilities while we are going for the calculation of absolute liquid ratio. So, in conclusion, the absolute liquid ratio can be calculated by dividing the absolute liquid assets by the current liabilities. Now, there also prevails a rule of thumb, that is, it is said that if the absolute liquid asset is half of the current liabilities, it implies that the company is having sufficient liquid cash to meet its short term obligations. But again, there are fallacies, there are contentions, there are exceptions with regard to those rule of thumbs. Even though the companies are having more than half of the total current liabilities, which is representing the short term financial obligations that a company is expected to meet, but there are cases and instances where the companies, even though they are having more than half of the current liabilities in terms of absolute liquid assets, but they fail to accommodate the short term financial obligations on time. So, there are again different apprehensions, different logics, different orientations to address why such things are occurring in the real world, and where are we lacking in terms of discussing or debating the same on a theoretical note. Now, to say, when we are going to talk about absolute liquid assets, we are taking it for granted that marketable securities are easily converted into cash, but it is not in the real world practice. If a company is holding rupees 1 crores of investment in short term instruments which are highly liquid in the market, but even then in times of need, when you are going to square off those investments in the market, it may so happen that the market moves in an unfavorable orientation and we are ending up with lesser amount of realization than the book value which is shown in terms of marketable securities. So, there are different explanations to such exceptions. Now, moving further, when you are going to talk about the ability of a company to meet its short term obligations, we are there to see to the fact that what is the average daily cash requirements, because the short-term financial obligations are going to be conditional upon the daily cash requirements of a company. Now, interval measure is going to address such issues, because through the calculation of interval measure, we are establishing a causal relationship between liquid assets in one hand and the average daily cash operating expenses on the other hand. Because we all know, for a company to operate smoothly in a perpetual manner without any hiccups, without any breakups, then we have to ensure that the company is having sufficient liquid cash to at least meet its daily cash requirements. If a company fails to do so, then obviously the regular activities which are expected to be executed in a business on a daily basis is going to be severely restricted. So, to calculate the interval measure, we are again using liquid assets. There are also different contentions. Why not absolute liquid asset? Why liquid asset in the interval measure? Because we are more or less going with the apprehension that those which are otherwise interpreted as liquid assets are possible to be converted into cash as and when the company needs or requires it. And against that, we are making a face off of the daily cash operating expenses, and we are essentially calculating that. Here there is a normal apprehension that if the companies are having more number of days of cash availability, because normally this is calculated in terms of days. Now, if let us say for example a company is having sufficient liquid asset which is going to meet the daily cash operating expenses for a span of 50 days. Another company who is having the liquid asset which is going to meet the daily cash operating expenses for a span of 20 days. Obviously, the company who is having a span of 50 days to meet the daily cash operating expenses, we are there to assert and purport that that company who is having higher duration is going to be better off to meet the short-term financial obligations. Moving further, whenever we are talking about classical liquidity ratios, we do not pay any heed or attention to the current assets, current liabilities and their characteristics. I mean to say, we are treating all the current assets as equal, but in reality they are not. When we are going to pose the issue that whether all the current assets are converted into cash with the same agility, with the same speed, without any shrinkage in value. Similarly, whether all the current liabilities are required to be repaid with the same level of urgency, the answer is a big no. Because if we see to the different components of current asset, say bills receivable, say debtor, say inventory, the number of days which are required for inventory to be converted into cash would be much higher compared to the number of days which are required to realize cash from the debtors, the number of days which are required to realize cash from bills receivable, from marketable securities, from short-term investments. So, it is imperative to make a discrimination among the current assets on the basis of the speed with which they are converted into cash. Now, when you are going to discriminate and decompose current assets with regard to the speed with which they are converted into cash, we are there to assign weights based on their speed of realization of cash on a subjective orientation. Similarly, whenever you are going to see to the current liability side and we are going to ensure and dig out the number of days which are required at the end of the company to repay different subcomponents of current liabilities, again there are differences. When you are going to talk about creditors and repayment of creditors, when you are going to talk about repayment of short-term loans, when you are going to talk about repayment of bills payable, when you are going to talk about repayment of outstanding expenses, So there are different span of time which are consumed by a company to repay all these current liabilities, though they are all related to short term obligations, but the number of days which are consumed by the company to repay all these current liabilities are different. So hence we are there to again discriminate among the current liabilities on the basis of urgency of payment and the time span which is consumed by the company in order to repay such current liabilities, because we are there to make arrange for liquid cash accordingly. If the number of days we are availing of is higher in terms of current liabilities, we are better off because we are getting more time to go for arrangement of cash. If the number of days which will be allowed to repay a particular current liability is very less, we are in a state of urgency. We are to go for the arrangement of cash as and when those current liabilities which are leading to urgency of payment, they are going to be dealt with. So to address all these issues, there is a separate genre of liquidity ratios which are otherwise more popularly known as weighted liquidity ratios, where we are assigning weights to all the current assets based on the speed with which they are being converted into cash without sinking its value. Then the urgency with which different current liabilities are to be paid, and accordingly we are there to assign weights. And after assigning weights, we are there to multiply all those individual current assets and current liabilities with that of the weights assigned on a subjective orientation, and we are there to calculate the weighted values of each and every component of current assets and current liabilities. Then we will go for the use of the formula which are used in a classical domain, like for calculating weighted current ratio, we are there to make use of the formula total of weighted value of current assets upon total of weighted value of current liabilities. Similarly, for weighted liquidity, weighted liquid ratio or weighted quick ratio, we are there to make use of total of weighted liquid asset upon total of weighted liquid liabilities or current liabilities. Similarly, for absolute liquid ratio calculation on a weighted orientation, we are there to go for the use of weighted absolute liquid assets upon weighted current liabilities in order to have a better view with regard to the calculation of weighted liquidity ratios, which are more closely and pragmatically addressing the ability of a company to meet their short-term financial obligations. Moving further, we all know the relevance and the significance of time value of money whenever we talk of financial decision making. Whether it is related to short term, whether it is related to long term, it hardly matters, but the time value of money and its significance is very critical whenever we are going to be into state of analysis, we are going to be into the protocol of arriving at financial decisions related to different span of time, related to different financial sub aspects of a company. So it is imperative to introduce and inculcate the time value of money while we are talking about liquidity, because time value of money simply implies the purchasing power of money, and in general, as all over the world we are exhibiting an inflationary orientation, so always the time value of money is on a declining trend. The more we are going to talk about future, the less we are going to end up with the purchasing power in terms of money. So whenever we are going to talk about liquidity, which is very sensitive to the span of time, we cannot afford to ignore the time value of money. So there comes a new generation of liquidity ratio by considering the time value of money, which is more popularly known as time adjusted liquidity ratios. Now the time value of money we considered while addressing the liquidity ratio by converting all the current assets and current liabilities using appropriate discounting factor. When we are going to talk about what would be the value of rupees 100 today after a month, definitely because of inflationary orientation, the value what it would face after 1 month, it is going to be less than what it is today. So technically speaking, the value of money is in a declining state, so we are there to calculate the future value of a present amount by discounting it. So when we are going to talk about the present value and we are going to blend the present value concept in terms of liquidity, we have no choice but to adjust all the components of current assets and current liabilities by exposing them to the discounting factor. Now, while making use of discounting factor, we are there to make use of the present value table, obviously, because the calculation is going to be very tedious when you are going to convert all the current assets and current liabilities in terms of time value of money. And that is why there are ready-made tables available at the end of each and every finance book, what we are there to refer to on the basis of the time span. Now, suppose say for example, bills receivable amounting to 50,000 rupees, and you are expecting to realize those 50,000 rupees after 4 weeks. Now, if rupee 1 of today is going to have a discounting value of 0.9 after 1 month hypothetically, now that 50,000 rupees is going to fetch a value of 45,000 rupees after 1 month. So that is the beauty of time value of money, and it is more or less facilitating us to calculate different liquidity ratios on a real time basis, because without paying attention to time value of money, if you are going to outrightly make use of those values which are getting disclosed in the financial statement, that reflects the historical value. It has nothing to do with the time value of money. So whenever we are going to talk about conversion of classical values of current assets in terms of time value adjusted current assets, we are there to dig out the span of time which are required to convert each and every current assets into cash. Similarly, whenever we are going to talk about current liabilities and time adjusted values of current liabilities, we are there to first dig out and evaluate how much time we are going to avail of to a particular current liability. If we are there to pay, we are there to avail of say 15 days to pay to our creditors. So the contract value to be paid to creditor is say 1 lakh rupees as per the terms and conditions between the company and the creditor. But the question is, now if we are paying 1 lakh rupees after 1 month, and if for instance we are paying 1 lakh rupees right now, there is a difference in the time value of money, because by deferring the repayment of creditors, we are always better off, because 1 lakh is in terms of numeral, today it is 100,000,000 and after 15 days it is 100,000,000. But in terms of time value of money, the purchasing power of rupees 1 lakh today and the purchasing power of rupees 1 lakh after 15 days is going to differ. So we are there to introduce that critical concept of time value while we are talking about absolute liquid ratio, and that leads to the new generation of liquidity ratio like time adjusted current ratio, time adjusted liquid ratio, time adjusted absolute liquid ratio and time adjusted interval measures. Because by calculating the time adjusted liquidity ratios, we are in a better position to appraise and evaluate whether in real sense the companies are having the ability to meet their short term financial obligations in time and come up to the expectations of different stakeholders to ensure that the company is robust in terms of finance to meet their short term financial obligations. Now with this, I am winding off the theoretical dimensions of liquidity ratio as well as their formula, their relationship with the current liabilities, and the extent and magnitude to which liquidity ratio is in a position to dig out the ability of a company to meet its short term financial obligations. Thank you.